But let's, guess, any questions or topics or anything in the news or interesting things to talk about? Or questions about, last class we were talking about technical indicators. Any questions about that or comments? Okay. Okay. You know, one thing that's interesting when we talk about technical indicators, yesterday was kind of an interesting thing, which, again, I don't believe it particularly in technical indicators. But on the other hand, what's interesting is, yesterday, like, the Dow Jones dropped below 8,000. And whenever you always hear in the news that the things drop below a particular level, that makes the news. And the reason things supposedly make the news is because they're important. And one thing that's, so when people look at, let's say, did it slide below a particular level that is, let's say a quantitative level, that's kind of a trade, that's kind of a technical kind of a thing. There probably are certain people out there who look to see when is it that the prices rise or above some kind of a symbolic numerical level. Because it seems like an interesting thing. People see it. If you break a barrier, people seem happy. If you go below a barrier, people seem sad, and that presumably has some impact on trading. So those are technical-like issues, okay, that come up. Whether you believe in them or not, they're a phenomena that is out there, and that is something we talked about. Support level, like in the context of what we talked about last. Well, I'm using technical here in a broader question of whether past prices tell you anything about the future. And so one question of whether you cross a symbolic number, okay, probably would be considered to be a technical type indicator. Here I understand that the Chinese like the number 8. Is this a good lucky number? Okay. Do people get excited if if an index crosses 888? Okay? If that might be, if you had a people here, again, I don't know that this is true, who cared about that, and the moment that happened, they got very excited and they bought more stock, that would be an indication, based purely on a technical indication, that it'd be a good thing to do. I don't know if that's the case or not. Okay? But that's an example of where there are these technical strategies, okay, that come in. Why they're appealing should be clear. Okay, and and although we're now no longer talk about technical strategies, and talk about some better founded strategies for, or let's say, a different class of strategies today, where there clearly is a computer sciencey way to think about trading strategies, and that's what I want to talk about today: is the computer sciencey way to think about trading strategies. But first of all, are there any questions about the programming assignment, the homework? How many people here have successfully tried anything on the homework? Okay. Good. Did you succeed in getting, you say you attempted to run something, is this correct? It is correct that you attempted to run it, but what happened when you ran things?
I buy stocks, the value of stocks is less than $100,000, it was okay. But if I buy more, it doesn't warn me that I do not have enough money. Just sell them and get a lot of money.
Okay, so you started out, what's supposed to happen in the simulation. Again, we have here, Yu, wave your hand, everybody. Okay, Yu is the dedicated DA who wrote the simulator. He did a good job under pressure to write it. Undoubtedly, being a person, there may be problems with the simulator. So let's just talk about it. So what did you think that happened? You're given an initial stake of how much? 100,000?
I just run the random strategy.
Right.
And it seems that I've got millions of dollars about more than 100 million.
I mean, you made $100 million from your random strategy.
Because I found that if I buy a lot of stocks initially, the system will allow me to do so, and at the end I will get a lot of money.
I see. So you're saying that you bought a lot of stocks at the beginning,
Yes.
and it didn't check your bank balance. Is that what you're saying?
Yes. So I think it's better to calculate
Okay, so first of all, so there are a couple of things. So what you're saying is, first question you're saying is, it may not have prevented you from buying more money than you have. Okay? And do you think that's possible?
Because I run the result, and the result is up to 100 to 1,000 million dollars at the beginning of 208. It seems that you will sell all my securities at the beginning of 208 a year.
2008, today, this year. Okay, so let's hash this out a little bit. So first question, there are a couple parts of your question. One is you're saying, I have found a bug in your simulator. If so, you need to send me and the TA. The TA's email is uyi. Is this correct? uyi at cse.hust.hk. Okay, he is the one that you should talk to if my simulator is. You should send it to me also, carbon copy. But I am getting something dumb from the simulator. Okay, he's the one to talk to, because if there's a bug, he's one to fix it. So there's two different questions. One is, the simulator will let me cheat. Should I cheat? That would be one question. And the answer to that is no, because the primary output of your project is a report as to how the relative strategies do, more so than how much money am I making. Remember, I said that I will take off 5 points from the paper with the strategy that had made the most money. Okay, that's because it probably employed some level of cheating. So you need to have some discipline to not try to cheat against the simulator, but try to figure out what's actually going on. Okay, try to understand a strategy. Now, if there's bugs with the simulator, that's a different question. Okay, and those need to be fixed and rerun.
Actually, I don't think it's a bug, but I think the simulator will allow us to use a large bunch of money, and at the end, we only calculate the ratio of our payoffs.
Okay, so clearly your payoff should not be in terms of absolute money, but you have to come up with the right way of assessing it. Okay, and it is a question of what the returns are. And if you're doing something that is weird, so there's a way of taking the numbers that he gives you from the simulator and determining a fair return rate. Okay, and that's a function of how much money you invested. Okay, and if you're allowed to invest much more than you have, then you've got to compute the return appropriately like that. If you think that he is cheating in some way, send me and him examples of how you cheated. Okay?
And there are also some minor bugs I found. It's not important.
Okay, if so, then what do you do if you have minor bugs? You send copies of the report to him and to me, and we will try to fix up the simulator. That's the important point. Okay? Any questions about that? Okay? Again, you could look into the question of whether, in fact, there might be a way you can buy more than your actual bank balance, your limit. But even if there can, you shouldn't be doing things to try to cheat with that. Okay? Any questions? Any other questions on the? Is there anybody else who got some results from running who got it to run and got some level of results? Okay? I strongly encourage people to try. Okay? Because there's going to be a certain learning curve in getting the results and interpreting them. One thing I did on my the web page is we posted a little bit more in the way of detail about what is supposed to be. Let's see if I can move this as possible. We posted a little bit more in the way of detail about about what the columns in the output report are supposed to mean. Okay, what was the date? What was the number of trades? What is your current amount of cash in the bank? What is the stock value? How much stocks do you own? What is your short liability? You're allowed to sell things short, meaning sell things you don't have. Okay, that will make it look like you suddenly have a lot more money in the bank. But beware that we are keeping track of how much you still owe in terms of these short liabilities that are still maintained. It says something about what your return is. Now, one thing that it says here that's consistent with what you're saying is that the return is being measured in the change in value. and not a percentage. Okay? And the interesting thing is going to be to compute it in terms of a percentage. So for now, you guys should presumably make this a relative return. You guys can use Excel, or you guys know how to take these numbers, okay, and convert them to a relative return, a percentage return, because that's going to be the more meaningful number to graph and look at. Does everybody agree with that? Okay? And finally, it gives you a total return since the beginning, okay, which may also be interesting. Okay? Any questions? But these probably, what you're saying is these should be returned normalized to be percentages, and I agree with that, and I would say you do that. Don't trust him to do that in the simulator. You can do that yourself. Any questions? Any other questions about the simulation or anything like that?
And also,
Yes.
this will use a data file named stock data.
Yes.
And we use the 4 data sets. Are they coincident?
Okay, so there are 4, his simulator, and you correct me if I say anything that is wrong. The simulator expects a file called stock data. That is what it's going to take as its world view of what's going on. Now, there are 4 candidate files you have for this stock data. Okay, they correspond to different time periods. Okay, the way I look at it is there are 500-ish stocks. There are 10 years-ish of data. We have broken this into 4 quadrants. You can use any one quadrant, okay, on a run with the simulator. Is this correct? By just copying that data file into the appropriate stock data argument. Okay? You can then run it and learn how you did here. I would encourage you to use one of these for training your method, debugging your method, and then maybe running it on all 4 to get some kind of idea of how robust or valid your techniques are. Okay? Perhaps my guess would be if you did well with your method on this quadrant, you probably will also do well in this quadrant, which means different stocks over the same period of time. Because if, let's say, this is a good time in the market, it was a good time here, it would have been a good time there. If for some reason you would become hyperactively tuned to each stock, you might do well here, because that's the same stocks at different times. Here would be a completely independent evaluation. Okay? And it'll be interesting to see how well you do when you're faced with different data. Okay? Any questions? So I encourage you to run it and see that and do some kind of experiments with it. Any questions? Any other questions or ideas about the simulation, where they sit? Okay? I encourage you to beat it out because I don't think it's a hard assignment, but I think it's an assignment where there is a learning curve, and that I think it's a fun assignment. Okay? Because I don't have to do it, but it's a fun assignment, I think. Okay? And the way that you will have fun is if you have time to think about it and start seeing how the dumb strategies, like holding everything in cash, do, and prove you can do a little bit better than that. That then starts to be interesting. Any other questions about the assignment? Okay? If you have any issues with it, send mail to you, Yi, and me. Okay? And we can sort of follow this up. Hopefully people will beat on it this weekend. Any other questions? Okay. At this point, Yi can escape if he wants. Okay? But maybe we'll want you back next time. Okay? For another appearance. Okay? Thanks. Okay. What I'd like to talk about now is we've been talking about trading strategies. And what I'd like to talk about that's, so far most of what we've talked about in this course, I'd like to think some of it was interesting, some of it was relevant, but very little of it was computer science if you stop and think about it. Okay? There was a lot of business, there was a certain amount of statistics, but it was very little to see where computer science might come in. So today what we're going to be looking at for today, and I believe next class, is a computer sciencey way to think about trading strategies. Okay? And it's interesting because, it gets us to, well, first of all, we talked last time about technical analysis, which, is this kind of mystical, weird idea about trading that doesn't seem very well founded. Here we're going to look at what I think is a well-founded theory for how you can trade. Whether it's a good theory or not is a separate question. But it does get us into computer science and algorithm issues. And it has to do with the way algorithms people think about online problems. So what is an online problem? Okay, what is an observation is that many problems in computer science involve trying to predict the future. Now, what does that mean? What's an example of something that tries to predict your future? Inside your PC, I see many of you using your laptops. Your laptops are desperately, as we go along in the course of the lecture, desperately trying to compute the future. What does that mean? There's a cache management strategy. Many of you are computer scientists, you should know about cache management. There's this vision that there is this small amount of high-speed memory, okay? And there is a big amount of slower speed memory, and an even bigger amount of even slower memory called a disk. And somehow your system is trying to figure out what stuff should you put in the cache memory, okay? So that next time you use you want to access something, it's in the fast part of the memory, right? That's what virtual memory is. When you talk about virtual memory, that's trying to connect what stuff from the slow disk do we want in the fast main memory? Okay, and what the answer is, the right answer is, we want the thing you're going to use next. And how do we figure out what the thing we're going to use next is? Well, that involves predicting the future. Okay? Likewise, when you think about cache, there is stuff that we're working on. It can either sit in cache or it can sit in main memory. We want the stuff in cache to be the stuff that we're going to use next. And how do you know what's going to be used next? Well, you can predict the future. If Intel comes out with an optimal predict the future chip, cache memory would be a lot faster, right? If it could sense the brain waves of the guy using the computer and know what they were going to be doing next. Okay, they could speed up the operation. World of Warcraft would run faster. Okay, if they knew what the player was going to be doing next. Okay, and so you may say, well, people don't know what the player is going to be doing next. Okay, there's a reason why you have a human sitting in front of the computer. But nonetheless, there are lots of problems in computer science that involve trying to predict the future. There are lots of problems in finance that involve trying to predict the future. Okay, a good example has to do with trying to sell stock. Okay, let's put it this way. Here is the current price. Should I buy the stock or not? Okay, if it's going to go up, the answer is yes, I should buy it. Right? If it's going to go down, should I buy it? The answer is no. The problem of how to do a trading strategy is in some sense it involves predicting the future. Because if I had a copy of tomorrow's newspaper, I would be a wealthy person. Because if I had a graph tomorrow showing me what's going to happen in the stock market, I would sit there very eagerly and say, okay, at this moment I'm going to buy. At this moment I'm going to sell. At this moment I'm going to buy, sell, buy, sell, buy, sell. I'd be a wealthy person at the end of the day. Okay? The trouble is it seems to be difficult to predict the future. All we have access to is the past. Okay? Any questions? Now, so when computer scientists talk about algorithm problems, they usually will talk about two different flavors of problems. They will talk about offline problems and online problems. An offline problem would be one where you're given all the relevant data at the beginning to compute the result. Okay? A good example of that would be sorting. Okay? You give me an array to sort. They say, Skiena, sort it. That is an offline problem. If, on the other hand, they say, give me I'm going to give you items one by one, and at each moment the data has to be sorted that I've already given you. That would be an online problem. And that's a different kind of a problem. Okay? It's clear that, if you're doing offline sorting, maybe you would do quicksort or you do something like that. if you're doing online sorting and you need to do that efficiently, well, you probably don't have too many choices. Probably you need to maintain it as a binary search tree or do insertion sort or something like that, because you're only getting the incremental data and you have to react to it. Okay, so there's a difference between online and offline. And prediction problems, to be interesting, are online problems. It's easy to go back and look at this stock trade-off and decide what I should have done. Okay? It's a lot harder when I'm only given a certain, basically a certain signal and told to make the prediction based on the information I have. It's clearly a different kind of problem. Any questions? So the question that algorithms people have thought about, okay, is what is the way that you can evaluate how well an algorithm forecasts the future? Okay, and this is a different, the answer that's going to be come up with is a different answer. And how many people are familiar with online algorithms and competitive analysis? I'm assuming very few. Okay, and is there anybody who will admit to it? How many people will admit that they don't know anything about competitive analysis, have never heard of this? Okay, very good. I see most people move their hands. Okay, so this is fair. So let's think a little bit about it, because maybe the most important thing is to understand what the model is and how you can reason about it. Okay? So if we want to try to decide how well an algorithm is going to forecast the future, let's say how well your programs are going to forecast the future. The usual way that you do it is thinking statistically. The way that we're going to decide that you have a good trading strategy. The most obvious one is to say, well, look, I read it on this data. When I simulated it on this data, I made 56%. Okay? That is how my algorithm did, and your algorithm only made 48%, and so my algorithm is better. Now, that's not a good way to think about algorithms for a couple of reasons. One is you've taken enough algorithm or theory classes to know people don't like statistical or experimental results. They like analytical results. And they like worst case results. Just saying that you had a statistical analysis of a result, like I made 56% on this data set, tells you nothing about what's going to happen when you run it on another data set. Okay? And it tells you nothing about what's going to happen when you run it at a different time. What we would like is a way to think about a worst-case guarantee of the quality of an algorithm at predicting the future. That's kind of what we would like to be able to do. And the way that the model that has been come up with is based on the following idea. We're going to compare the performance of an algorithm which only has knowledge of the past with an algorithm that has knowledge of both the past and the future and makes the best possible use of it. So one way, the way that we're going to score the algorithm for trading, if we think of it in this world, if we want to compare your algorithm A, okay, your trading strategy A, okay, we are going to compare your score not by the percentage that you go up, but by the comparison of how you would do relative to the guy who had the newspaper. So let's say this is a Skiena. Skiena is an optimally smart person. And he has, more to the point, he has the whole day, tomorrow's newspaper in front of him. You are algorithm A, perhaps named after the grade you're seeking. Okay? But you only have a certain amount of data here. The way that we're going to compare how good your strategy is in some sense the worst case ratio. Okay? I guess, okay, whether we put let's put Skiena above. Again, a ratio is a ratio if you have A over B or B over A. But let's think about, we consider what are the returns made by Skiena versus your algorithm. Okay? If your algorithm was great and you could really predict the future perfectly, your performance will be as good as me making the best use of this as possible. The best use was, presumably, sell right before it goes down and buy right before it goes up. I would get a certain return for it, okay? The ratio of me to you okay, is a way to compare how good your strategy is. How good is your strategy compared to being the best use of clairvoyant? And what we're going to try to do here is to look over all possible futures. If you think about it, on any given future, okay, the future being the data in the newspaper, my strategy will earn something, and your strategy will earn something, right? If we compare the ratio of me to you, it still seems like a statistical thing, right? If I give you one particular future, we can get a ratio of how you did to me. But analytically, what we're going to now do is we're now going to take a look at what was the, we want to look at over all futures, okay, what is the, I guess, let's think about it. If your strategy is, if you want to show that your strategy is good, the worse your strategy is, the higher this ratio is, right? If I am perfect all the time because I know the future, and you don't know the future, okay, my performance will always be bigger than you. If this is a return versus this, my return will always be at least as high as yours. The ratio of me over you, the better you are, the smaller that ratio is. We're going to take the max over all possible futures. I guess that's probably the way to write it. Okay? The max over all possible futures of the ratio between me and you. Okay? The smaller that is, the better your algorithm is. Okay? And because we're taking the max over all possible futures, somehow, this is now a well-defined worst-case thing. There is no longer any statistical thing in this. That's the interesting thing here. Okay? It may not yet be clear how we can do this kind of analysis, but it should be clear that with this kind of a measure, we have a way to compare my algorithm to your algorithm. Or we compare your algorithm to the best possible thing. And we can compare it over all possible futures and get a worst case result. Okay, and we're back living in the worst case algorithm analysis world that we all are comfortable with and happy. Any questions?
It can be negative because A can be negative.
Excuse me, what?
A can be negative, so the whole amount can be negative.
Okay, well let's say that in this world, again, there's some questions about the mechanics of the ratio. If A can be negative, then this is going to be weird. Let's say we live in a world where A is positive and S is positive. Okay? And, A is always less than F because S is the optimal one. Okay? Then everything I said about the ratio makes sense. If they allow negative values, then I agree with you that the definition of the ratio is weirder. So we have to define our problem in a way that we don't get negative ratios. Okay? Any questions? And I'll make that more concrete in a minute. Any questions? So again, here's what I said, just to say this again. An algorithm, an online algorithm, we say is C competitive. If there is a constant, actually C, you can't read that very well, okay, such that for all input sequences, all possible futures, okay, the value of that you get, okay, over opt, okay, that comparing the optimal performance to yours, there is a constant, and that over all possible futures, you always do within a constant times optimal. Okay? That's the idea here. Now, whether this is the exact formulation of this is weird. Do you mean a minimization problem or a maximization problem? And then the role of whether we mean C here or 1 over C or greater than or less than changes. But the important thing that we're doing here is showing. If you can show that yours always comes fairly close, okay, to a constant times optimal, then we say it is C competitive. Okay? Any questions? This kind of algorithm analysis is different than what you're used to in we are not going to worry so much about the runtime efficiency, but how good you are at predicting the future. Okay? If you went into some hedge fund and said, I have a great way of predicting the future. I can predict the future of every stock price perfectly, but it requires $10 million worth of computers, they will say, here's $10 million, buy them. Okay? And here's another $100 to have lunch. Okay? So the issue here is how well do we predict the future? Not what is the cost. We want our algorithms to be polynomial in the future, but more than that, we're not going to worry about it. Any questions? So let's look at a concrete example of how you might be able to do this or reason about this competitive way of doing it, which is interesting. One thing that we know, how many people here know what skiing is? Does people know anything about skiing? I know Hong Kong's a famous ski capital because you have a lot of mountains here. But unfortunately, you don't have any snow. Okay? Who here knows about skiing? So skiing is a sport. It's popular in the United States. You have mountains, you have snow. And you put these sticks on your feet. Okay? And then you slide down the mountain fast. Okay? And people like to do this. Now, the trouble in doing this sport is that you have to have skis. Okay? And when you go to a ski mountain for the first time, or every time you go to the mountain, they will ask you, do you want to buy skis? Or do you want to rent skis? Or do you want to use the ski that you brought in with you? Okay? So if you buy the skis the first time you ski, you pay a certain price for the skis, and then you know every time you go skiing, you will not have to rent skis again, right? An alternative is you go and you say, I'm only going to rent the skis. Okay? So let's say maybe it will cost, in US dollars, I'm going to make up some numbers, $100 to buy skis. And $20 to rent skis. Okay? When you are going to the skis, okay, are there any applications here, games here, or worlds here, where you are faced with the decision repeatedly, do you rent or buy? Okay, I know in Hong Kong, is there anything that people do here, where people sometimes have to make a decision of to rent or buy? To a certain extent, an apartment is like that, right? Every day, if you have enough money, let's say, forget about the cost of, I have to save enough. Let's say you have a bank account where you can either go and buy a house or rent a house. And every quarter they're going to say, do you want to buy our house? You could buy it now, okay, or you could keep renting it. And that issue is, so it's a similar situation, except I guess here we're only interested in the question of the cost of it. Okay, don't worry about appreciation. So, if you're going to go skiing, let's think about this world. It costs $100 to buy skis. It costs $20 to rent them if you decide to go skiing. When you go into the ski slope for the first time, should you rent or buy? Okay? Let's think about this question. Should you rent or buy? Does anybody have any opinion? Okay? Okay? There is a right answer if you know the future. What information do you need to know about the future to help you make the right decision about whether to rent or to buy? Okay? If you live in a world where you're going to go, you have you have a choice every time you go skiing to rent or to buy. Okay? You know what the prices are. What piece of information do you need to know in order to know whether to buy skis at this point? Okay? You may not have that information, but what would be the information you would really like to know about the future? Okay? Whether you're coming back or not, or even more precisely, how many times you're coming back. Right? Before you buy those, go to the ski, here's the ski counter. Okay, here's where they have the racks of skis, right? You're faced with this decision. How many times will I come back and go skiing? Okay? If I go skiing, if this is the price point here, how many times do I need to go skiing so that it pays to buy my skis? Okay, if it costs $100 to buy and $20 to rent, how many times do I need to go skiing to make it pay off? 5. Does everybody see that? So the real piece of future information I need to know is, will I go skiing 5 times or more? Okay? And the trouble is I have no way of knowing that. Right? I may find that I go skiing once and I don't like it. Okay? I may find I go skiing once and I slide down the mountain into a tree and I hurt myself and never can ski again. Right? So the question is, how can you go and decide whether to rent or to buy? What would be the right strategy to do? Or a reasonable strategy to do? Any ideas? Let's think about this. How would you make a decision like this? Okay. How would you must be faced with decisions like this from time to time, right? Okay? What is usually the idea? Okay? The argument would be, let's look at the actual costs and let's think what the idea is. When I go skiing, I can buy them at a cost of X. I can rent them at a cost of X or buy them at a cost of BX. Here I guess B is 5, right? If I buy them the first day, the worst case would be that I never went skiing again. And if so, I would have paid B times X for what I could have gotten away for a cost of X, right? Now, on the other hand, suppose I never buy them, okay? If I go skiing K times, where K is bigger than B, okay? I will have spent K times, okay? Let's just think of it. Suppose I go skiing K times, okay? I will spend KB, okay? Where I could have gotten away with X, okay? Not KX. I could have gotten away with X, BX. Wait, no, hold on. All right. KX is what I would have paid. I could have gotten away with BX, okay? And so long as KX is bigger than BX, okay, then I would have been smarter off having bought. Does everybody agree with that? So what is the right time for me to buy skis? Okay, if I bought them the first time, I would run the risk that I break my leg and never ski again. Every time, though, I don't buy it, okay, I am adding more and more to what I have lost by not having bought it. So what is a good strategy? Suppose I buy them after I rented B times. Okay? Now what is my cost going to be? Let's look at this. Let's maybe plot the cost. Every time I go up until B, I will rent, so I'm paying this much. Then at time B, I've decided I'm going to go buy it. I'm going to have to pay the cost. Buying it will cost me BX. My cost will suddenly go up and then be flat from then on. Does everybody see that? The optimal strategy, the linear strategy of renting, is here. The important thing to see here is I am never paying more than twice. If I go through this strategy, I'm never paying more than twice what I would have paid, okay, in the optimal case. Because if I break my leg here, I'm out half my money, total. Where if I bought it at the beginning, if I broke my leg here, I would be out, B times my money, okay? Any questions? So do you see how this kind of view sort of balances things? And it creates what we would call a two-competitive algorithm. I am never paying more than twice what I would pay if I knew the future. Okay? Even though I don't know the future. Okay? Any questions about that? This is the coolest, neatest example, so it's a good question to discuss it. Any questions? Okay? This gives us a way to now balance this thing, come up with a strategy that is provably good, provably optimal by this competitive ratio. Okay? I will never have spent more than twice as much as I needed to with this strategy. Where any other strategy, I might end up spending more than twice as much than I needed to. Any questions? Okay? And when you think about it, okay, it becomes, in designing these games, you're sort of, these strategies, you have to think of yourself as playing against somebody who's trying to make life difficult for you. Okay? That there is a mean person, an adversary, designing your future to make the outcome as difficult as possible. Okay? If you bought over here at the beginning, the adversary will make sure that you trip and break your leg right as you walk out of the store. Okay? If, on the other hand, you decide never to buy, okay, it will learn that the adversary will make sure that you just like skiing enough that you always want to go one more time. Okay? And we can kind of think of these online algorithms as trying to figure out, we're trying to do the best we can in a world where the future is trying to always make it as difficult as possible for you within the rules of what is allowed. Any questions? That's what we mean by an adversary. Okay. Any questions about the ski example? Okay, let's think about now another financial, maybe more realistically financial trading oriented problem, where we are, where this kind of online analysis might help. Suppose we are in a world where we want to sell a house over over a period of time. So here is today. Here is the end of the period. We need to sell a house by then. What properties do houses have? Houses have prices. But the price of the house changes each day, depending upon what people, the housing market some days are good, some days are bad. Okay? If we could predict what the price of the house would, what are interesting properties of houses for this example? Houses have the property you can't sell half of a house. Okay? That's what we mean by an indivisible asset. Okay? You'd like to sell something you can't divide, but the price fluctuates. Okay? The housing market may have the property that the price is going to go do something like this. Okay? Suppose you're now faced here today with the decision to sell a house. And this is what the price of future is. When should you sell the house? Okay? We'll say that we know the house goes between, it's never going to get above M and never going to get below little m. But otherwise, price is free to fluctuate in this range. Okay? And we know nothing about how it fluctuates. What would be, if we knew what the future held, what would be the right price to sell our house at? The highest one. Does everybody agree with that? If we knew that there was going to be somebody who was willing to pay the house at that price, the right thing for me to do is to say, I will sell at that moment. And then I would do as well as I could possibly have done, right? So we live in a world where there is an underlying price. I want to sell one thing. Maybe it's clearer if you think of it as I want to sell one share of stock, right? The stock can move up and down. The price is published, okay? But if I know what the future is, I pick the highest price. What if I don't know the future? Okay? How now can I decide when to sell the thing? Okay? We live in a world where the price is going through certain motions. Okay? You've got to make a decision as to when to sell, right? And we want to maximize our competitive ratio. What might our adversary do? Let's think about it. Okay? Suppose the price goes very high now and you don't sell. What might let's say at this instant it was up here for an instant and you didn't take advantage of it. What would the adversary do to the price in order to make you maximize your unhappiness? If the price suddenly dropped and sat like this, you know you can always sell at the lower bound. Congratulations, you've now got little m. But you know you could have gotten this value of p if you had been smart enough to see the future. Does everybody see that? Okay? On the other hand, what do you think your adversary would do? Okay? If you do decide to sell. Let's say we're going like this. At some point, maybe you're going to sell. If you decide to sell here, what do you think the adversary is going to do with the price to make sure that you are as unhappy as possible? Well, what? Suddenly, boom. And it'll make sure that for the rest of the period, it's going to keep the price really high, knowing so that you will actively regret having settled for this price instead of that price. Right? What should your strategy be to decide when to buy, when to sell? Let's think about that. Let's try to think about possible strategies you can use for this problem. Okay? There's a price that is wiggling around. You have an instant to decide whether to take it. What should be your strategy? What might be your strategy to decide to take it? Okay, so you're now coming up with an interesting idea. Let's first come up with other ideas. Okay, just to make sure that that might be the right answer. Okay? Any other ideas as to how you might decide when to sell it? Okay, well, you're saying geometric mean. What is the geometric mean of these things? That was going to be the square root of little m times big M. What would you do with that price? You're saying that you would sell it. What would your strategy be?
My strategy, sell at that price.
So you're saying draw a line at this geometric mean. And you're saying that if it ever gets above this price, the moment it hits it, you sell. And if not, you wait until it hits it. That is your idea. Why the geometric mean? What other means might be reasonable? Okay? Possibly the arithmetic mean, right? Okay? Why do you pick the geometric mean?
Yes, I want the big M over price equals to the price over the small m.
The idea here somehow is we're scoring ourselves by ratios. Okay? That's basically what he's saying here. Okay? And that what we want to do is to seek a price here. That's basically what I was kind of saying. Was the following. As I said, the moment we sell, the price will go up. The moment we do not sell at a high price, if it's at a high enough price, the adversary will drop the price forever. Okay? What we would want to do is to set it at a price level, P's prime, such that we minimize our regret in both of these cases. That's the way that I'm thinking about it. When you say geometric mean coming out, that might be the right answer. But to me, it still comes out. I don't quite see why it comes out. The reason why it comes out in my mind is I want to think, if I sell it at P prime, what is my regret going to be? If the price went, if I did, was just under P prime, and I didn't take it, I will have done how much worse than I could have? I will have done P prime over M, little m, times worse than I could have. Right? If the price stayed at P prime minus epsilon, if the price just got up to there, below it, and I didn't go for it, and then it plunged down to nothing, that's the way I would be most unhappy with this strategy. Does everybody see that? If on the other hand I take P prime, what is the level of unhappiness that I will have? The level of unhappiness is I got P prime when I could have gotten M. So to minimize my unhappiness, I have to set these, pick P prime so these things are equal. The epsilon doesn't matter, right? And now then, where does this come from? Multiplying this becomes P prime squared equals big M, little m. And you do get P prime is equal to the square root of this thing. Does everybody see that? By balancing our unhappiness in each outcome, we can identify what is the right pricing level under this kind of a model. Any questions about that? People sort of see that? Okay? Any questions? And so what's interesting is, that gives us, if we set that, say that 5, okay, is the ratio of M over M, what we call the fluctuation ratio, the difference between how big it can get and how little it can get. Basically, we have an algorithm which will give us a strategy that will always get us within a square root of 5. Okay? And this is sort of the optimal deterministic way to sell a house in this particular environment. Any questions? Okay? Any questions about that? But there are other ideas we might be able to use in designing this trading strategy. Okay? We don't necessarily have to think deterministically. We can use a sort of randomized ideas and randomized algorithms. And it turns out that sometimes in this trading strategies, this is an interesting idea. A randomized algorithm is one that you generate random numbers from some source, okay, to design algorithms unlikely, okay, to, to encounter the worst case, okay? And randomization is useful if we have an adversary that we're facing who knows what our strategy is going to be, okay? If our strategy is deterministic, the adversary can design a future as bad for us as possible, okay? If the adversary knows our strategy, but our strategy depends upon random numbers we don't have at that point, the adversary doesn't know these random numbers, okay? And they can design a much worse future for us. They can't design a bad future for us. Let's think about it in a casino setting. You go to Macau, okay? You have an idea as to how you're going to play roulette, where you can bet on red or black, right? It's like flipping a coin. Suppose that the particular casino I go into in Macau is a corrupt casino, okay? They're trying to cheat me, okay? If they know that I am going to be betting because I like black, red, black, red, black, red, what would the casino do with the spinning wheels go? I would put a certain amount of money on, I would start out here. Let's say this is my return. I would bet on black. The casino knows I'm going to bet on black. It would have the wheel come up red. Okay? I'm now going to bet red. It's going to say next time I'm going to make the wheel come up black. Okay? It's going to come up red, black, red, black, red, black. Does everybody agree that if I came into the casino with a strategy of how I'm going to bet, and the casino could set the wheel the way it wants, It could make me do arbitrarily bad. What would be the right way for me to bet at this corrupt casino? Okay? If they couldn't program, it's a world where they have to program the wheel in advance. What would be the right idea to frustrate them? What if right before I got to the casino, each time, before I put my money down, I pull a coin out of my pocket, flip it, look what the answer is, and now bet. They have no way of figuring out now what is it that I'm going to be betting on until it is too late, right? The adversary can't hurt me because an expectation. My expectation is going to wander around zero now. Whereas if I didn't have access to a randomized strategy, okay, if the other side knew what I was going to bet, they could have the answers come out arbitrarily bad for me. Any questions? So this is the idea that I might do better with a randomized strategy. Okay? How many people sort of see that idea? Okay? It's a little counterintuitive, but it's a question of, again, once you understand that what we're trying to do is that, that instead of us, the adversary, being able to construct the worst possible future, the adversary is going to construct the worst possible future they can, not knowing our random number choices. Okay? And in this case, they can't do as bad, okay, as otherwise. Okay? Any questions? Actually, what I said is a little bit misleading. Okay? Well, not me, but notice what the idea here is. When we talk about randomness here, we're not going to be making an expectation argument. What we're going to be doing here is saying, what is the worst case that we can do? Okay? The casino has to offer us a future. Okay? We are still going to consider over the worst possible futures. Okay? But we have the randomness to try to choose what we do. Okay? They have to pick the future, and then we pick the randomness. Okay? And that's somehow where the decoupling is. Any questions? Let's make this concrete now. Suppose, let's say, this is now an example of another randomized strategy. All of you, I trust, have seen a bicycle. Okay? Bicycles have wheels. And bicycles have rubber tires, right? And bicycles run over tacks and things and get flat. Okay? Has anybody ever had to face the problem of trying to find where the leak is in a tire of a bicycle? Okay? How many people have done this? More people than have skied. Okay? Now, let's say that we are faced with a bicycle wheel sitting in our bicycle, right? And we want to now, the way I think of bicycles is that there is this fender running around. And you can only see part of the wheel at a time, right? And it takes a certain amount of time to actually touch it to figure out where the leak is, depending upon what quadrant is visible, right? Now my question is, I give you a tire wheel. What is the right strategy to figure out which quadrant is it that has the leak? If you knew which quadrant, if you knew the future, you could mentally say, aha, this is the quadrant with the leak, and turn the bicycle, and then feel only one quadrant. If you knew the future with one turn of the wheel, you would be able to find the right place for the tack, right? What now if you're going against, how else might you search for a tack? You might say, let's feel over here right now, what's at the bottom? No tack. You then have to make a decision, do I turn the wheel to the left or the right? Suppose you turn it to the left. What would your adversary do? Okay? To make it as hard. Suppose I'm turning the wheel to the left. And at each time to search, I'm going to turn the wheel one quadrant to the left. Where would the adversary put the tack? Just to the right. Does everybody agree that if I'm doing this, this is what the adversary is going to do? I feel no leak. Turn it a quarter. No leak. Turn it a quarter. What though if the adversary, I'm going to use a randomized strategy. Suppose the adversary has to put the tack in, and then I can spin the wheel. Okay? Randomly. You know what you do? You spin the wheel, and it stops someplace. Now, what is going to be the case? No matter where the adversary put the tack, it is equally likely it be in any one of these bins. Does everybody see that? Now on expectation, if you wish, okay, my expected strategy of going to the left is the same as going to the right. And no matter what the adversary did, it will now take me on average n over 2. Before, the adversary could guarantee that I spend n. Now, no matter where the adversary puts this tack, my expectation is n over 2. Okay? And that is an example of where a randomized strategy has a win. Okay? Any questions about that? Question like, I don't get that one is good, because the analysis of the next strategy is going to be a little more complicated. But you see how randomization makes this easier somehow. Okay? It enables us to avoid certain worst-case futures. Okay? Any questions? Okay. Now, let's get back to our house selling problem. We live in a world where here is the lower bound for the house price. Here is the upper bound for the house price. Okay? The price is going to do its wiggling. The future wiggling is set by the bad guy looking at my strategy, but not knowing about any random numbers I'm going to use. Okay? Any ideas how I might be able to do this differently using random numbers? Okay? Well, one idea would be, what if I pick my price randomly? Okay? Now the bad guy doesn't know what my price is. Right? If I pick my price randomly and uniformly, now the bad guy does not know how to set the prices to hurt me. Right? Does everybody see that? Okay? That if I'm going to pick it randomly and uniformly, maybe the right thing to do would be that the bad guy is going to want to set some price and hold the price constant at that point. And that with a certain probability, if I picked anything up from here to here, I wouldn't get the house. And if I picked any price from here to here, let's just think about this. If I pick my price uniformly, what the bad guy's strategy probably should be, if you stop and think about it, might be to ramp it up, and then at the point where it picked, okay, if I picked anything from here to here, I would get the value depending upon, okay, so suppose the bad guy's response to this, the adversary will probably do something like this. Set the price to be 0, minimum initially. Ramp it up to a particular value. If my random price fell in this value, I would get exactly what was it that I wanted. Okay, but it only goes up to a certain point. If my random price was anywhere else above this, I would be unhappy. Okay? That would be a way that the adversary, there would be a certain price level which would be best for the adversary to do it if my strategy was to pick a random price. That actually I now think I have said properly. Okay? If my strategy is pick a random price in this interval, the right thing for the adversary is if it knew my strategy for how I pick random numbers, let's say uniformly at random, let's say biased in some way, the adversary could say, well, I will design as a future of the type that ramps up to a certain level. So if the random pickup price was below that level, I would get it. But if it was above that level, I wouldn't, and would then have to settle at the end for the bottom price. Okay? Any questions about that? That would be one strategy here, to pick a random price. Okay? In fact, there's a, let's say, interesting variant of this that is sort of the right argument for how to look for a price in this model. Okay? We agree that there is this phi value, which is the ratio between the lowest price and the highest price. Let's say that that ratio is 2 to the k for some value of k. Meaning m, the upper bound, is little n times 2 to the k. That's what it means here. Okay? And if it's not, it's an approximate thing. Okay? What we're going to do, that means, if this is true, if the upper bound is basically little n, the lower bound times 2 to the k, we can take our price space and decompose it into log n levels. This is by at m. This is by at 2m, 4m, 8m, 16m. Does everybody see that what we can do now is define a logarithmic number of levels representing every possible doubling of the lower price? Okay, and that there are log of phi, because the upper bound is the lower bound times 2 to the k. There are k levels, okay, of doubling between the upper and lower bound. That's supposed to be simple to see, so hopefully people see that. If not, a question is a good one. But if the upper bound is of the form, if this is m, and this is little m times 2 to the k, then there are k levels in between where we can double the lower one. Okay? Any questions? The randomized pricing strategy is going to say, I am going to pick one of these levels, okay, uniformly at random. Okay? Or equivalently, I'm going to pick a value of I from 1 to k. Okay? And that is going to be the price that my strategy is going to pick. Okay? As being what I am willing to sell the house for. Okay? If the adversary knows that I am using this strategy, but doesn't know what my value of I is, the adversary has a problem. If it knew what value of I was using, the adversary would know exactly what to do, right? The adversary might say, oh, look, you're only going to sell for a high price, right? I have decided I will let the price be exactly below what you want to torment you up until the very end. And then you would suffer the regret of you could have gotten essentially your price, but you had to get the lower bound. If, on the other hand, your price over here was very low that you happened to pick, the adversary will make sure that you actually get your price, and then ka-chunk, the price goes up to the top. Right? But the adversary does not know your price. The adversary only knows that you picked one of these k levels with equal probability. What is it that the adversary can do? The adversary will figure out there has to be a best level for it to pick at. And what it's going to do is come up with a price distribution for this, pick a level that it thinks is right, okay? And give you a price that is always just below that at that level, okay? Any questions? To figure out what that price is, okay, basically we're going to do an analysis. Okay? If we picked I, level I, and the adversary picked level J, our target, okay, will be too big, okay, if there's a randomized target I, right? What's the probability that our level was too big? Okay, bigger than what the adversary picked. Okay? No, that there's two possibilities. Okay? If our level was less than the maximum price. Okay, let's go back here again. Let's go say this thing. There's two possibilities. Okay? Our target, either when we picked it, was either going to be below the adversary's J or above the adversary's J. Okay? Our target is going to be too big if we won't settle if we are above that level of J. Okay? If this is where the guy was willing to sell, if there's K levels, K minus J, okay, are the number of levels above what the adversary picked. There were K possibilities. The probability that we picked a level above what the adversary picked is K minus J over K. 1 minus that is the probability that we picked a level below what the adversary picked. Okay? And depending upon whether we were above or below it, that sets what price we were going to get settling for. And if we do that, we then get the following kind of an analysis. The expected payoff, if the adversary picks level J, okay, the adversary is going to pick a level that maximizes its punishment it can cause us. If it picks a high level of K, the odds we can get the price that a high level J, the odds are very good we can get the price that we want. Okay? If on the other hand it picks a low level, the odds are basically we can't suffer too much in the other direction. So our sum is going to be, basically, for whatever the adversary's level J is, there is a certain probability we're forced to settle for the lower bound. And otherwise, a probability that we get our price. The expected value of this strategy is going to basically be the probability we settle for the lower bound times the lower bound times the probability that we get our price. Okay? And this is what our expected payoff is. The optimum value is going to be, okay, that we had set the price right where the adversary was. Okay? Which would have been at this value m times j minus 1, minus just below the threshold. This is what we would get for a given value of j. The adversary is going to pick the value of j that makes its competitive ratio as bad as possible. And when you simplify it, the dominant terms turn out to be the m's go away. You've got a 2 to the j on top and a 2 to the j on the bottom. Basically, you've got a function that's going to grow sort of as k times this over this. It's going to be order k. Okay? And that's an argument that the worst this can get is order k. Okay? K was the number of levels. K was the log of the number of levels. The argument is that this gives you a competitive ratio of log 5, which was better than somehow the square root of 5 that we had with the deterministic strategy. Any questions about that? Okay, the analysis you may get lost, but the idea I think should be an interesting one. Okay? Any questions? Okay? This gives us an argument as to how we can sort of trade, and that having some randomness in our strategy is the right thing if we are dealing with a hostile adversary. Any questions about this line of reasoning, this line of analysis. Okay? It's competitive analysis, why it's a good thing, why it's a bad thing. Okay? I think I'm going to talk next time, I think, about some generalizations of this. But let's just go through this. Any questions here about the analysis? We've got like 3 minutes. So I'd like a 3-minute question, if possible. Okay? How about any questions about the homework assignment? Okay? Those might take 3 minutes. Are there any people who came in later who had started the homework assignment? Okay? Who had any experience or questions about how the homework assignment is going? Okay? I encourage people to over the weekend, do some runs, get your simulations going. Okay? So we can decide if, basically assess whether there's any problems with that. Any questions? And if you haven't picked up your homework ones, I have those here too. Okay. Any questions? I'm going to make people sit for the next 2 minutes, unless there is some question about anything going on in the world, or finance, or anything like that, to bring people alive here. Okay? The interesting thing again about why does this randomization work? It is interesting because somehow randomization is a way that we can guide it, prevent us from being strangled by any particular future. You can't design a bad future if you know that I'm making random decisions. If you know that, again, you see this kind of strategy a lot. Let's say that I am a prisoner escaping. I see there's a prison not far from where we are living, right? There's a guy in a guard tower with a gun, right? If this prisoner tries to run out of the building, okay, and tries to escape, okay, if his movements are predictable, he has a bad future ahead of him. Is that correct? What is the right strategy for the prisoner to get out? To avoid, okay, getting shot. They better pick moves randomly, not left, right, left, right, left, right, because the guard is smart enough to catch on to that pattern. If the guy is really going to take flip a coin at each step, okay, no matter how smart the guard is, the guard will not be able to predict his movement, and the guy has a chance. Otherwise, he's dead in the water. Okay? And that is why randomized strategies are effective. Any questions? Okay, now I will let you guys leave. Okay, take care. We'll talk about next class. Think about this. Look at this thing. We're going to look at some other financial problems that are natural that we can analyze through these competitive strategies. Okay? And so think about it, and we'll talk about it next time. Thank you.